All right, so as I mentioned before, current liabilities appear riskier than non-current liabilities simply because we have to have liquidity in order to take care of them, right? We either have to finance them with some sort of short-term current asset or some other arrangement that we have to, kind of go into crunch time and find something to replace it. The current ratio and the working capital serve as as frequent covenants on loan contracts. And so if you remember, the current ratio is current assets to current liabilities, and working capital is just the two subtracted from, or current liabilities subtracted from current assets. And if you remember also, covenants are items that can, once triggered, speed up the payment of principal on a loan or enforce a higher interest rate to be paid. And so maintaining a certain level of current liabilities is always attractive to a firm. Recall that, of course, current maturities of long-term debt, that debt becomes current in the year of its maturity. So if it's coming current next year, it should be included as a current liability. And this also applies to debt that has become callable, even if it's not expected to be called. Callability is when the firm, the issuing firm, the firm that issued the debt, is able to buy back the debt issue. So even if we don't anticipate that they're going to exercise the callability and buy it back, it still becomes current. It's sort of a conservative treatment. And of course, remember that if we are going to refinance a current liability with a long-term liability, that is a condition under which it becomes a long-term liability. And as I said, if you break a covenant on a debt issue, there are penalties, perhaps accelerated prepayments or something like that. If there is a covenant restriction and the covenant conditions are actually triggered, then that debt would become payable, and it should also be a short-term liability, a current liability, right? Contingencies represent liabilities that are not certain to occur, but are possible to occur. They're going to depend on some triggering event that's still in the future, maybe a pending lawsuit, a product with an attached warranty, promotional programs, product recalls. So since this isn't a concrete obligation, since there's no legally enforced maturity date, reporting becomes a little trickier. We depend on thresholds of likelihood and also the estimability of costs. So the first is the likelihood criterion, and it's either going to be probable, more than 50%, possible, which is a gray area, and remote, which is a slight chance of occurring. When something is probable and reasonably estimable, so this is when we would recognize a contingency, is at the probable threshold. These two just need disclosure. And if it is probable, it must also be reasonably estimable. So it has to pass both of those criteria for it to be disclosed and recognized. And we would have a loss on the contingency, whichever type it was, and a contingent liability credited. If the loss is possible, then disclosure is required, but again, not recognition where we actually alter account balances. And in the case of a contingent gain, we don't record the receivable, even if the likelihood is virtually assured. A disclosure is mandated for material gains. But again, this is a sort of aspect of conservatism where a gain could be 99.9% likely and we still won't record it until we actually realize the gain. We don't do it ahead of time. Warranty and promotional liabilities are special types of contingencies and are going to be recorded by a lot. Right, we're guaranteeing product, and the resultant contingent obligation is that the customer is going to return it after we've sold it. because the guarantee is part of the sale, because it helped generate revenue, it gave the customer that assurance that even if something goes bad, we can bring it back. So I'm more likely to buy it. Then we want to record it as an expense in the period of the sale, not when it's estimated that the liability will be returned. Okay. So the obligation is accrued during the period of sale, debit warranty expense, credit warranty liability or warranty payable. And how do we measure the potential expense? Typically going to be on a historical average of costs as a percent of sales for the warranty products. Warranty costs as a percent of the cost of the product in some cases. Even warranties that extend beyond the current reporting period should be assessed and expensed in the same period of sale. So let's look at this example and you'll see what I'm talking about. Avalanche has 2-year manufacturer warranty estimates, a little high on the manufacturer side of warranties, but we'll go with it. 4% of warranty returns after the first year are estimated and 2% in the second year. I say that they estimate this on a percent of their sales. Say that they recorded $200,000 of sales in 2016. They actually had replacement costs of $6,500 during 2016. So the first, of course, you just record the sale, which is, we'll assume cash for $200,000, and that generates sales revenue of $200,000. We would also, of course, want to record COGS and inventory. If I had given you cost data on it, but I didn't give you a cost price. Record the adjusted entry to accrue expense. In this case, we would take the sales amount and multiply it by the total of our historical averages. So remember, it was 4% in the first year, 2% in the second year, and that's going to be 12% overall. 6%, which would be $12,000 of warranty expenses overall. Now, the warranty expense will all go into this period. You might separate out the warranty payable or warranty liability into two. This would be a current liability. This would be a long-term liability. The long-term liability would be the returns that would be likely to happen 2 years down the road. The short would be $8,000. So something like that could be a way you would record it. You could just lump them all as $12,000, but then remember that you should separate them on the balance sheet. Warranties payable. When we have some confirming event of items being brought back, we reduce our warranties payable by $6,500 and then credit whatever we used in order to satisfy the warranty, maybe as cash, inventory, maybe we have to pay our employees more because of work they performed to fix the item that came back in. But anyway, that's how this would look from just a regular warranty estimated on historical sales averages. There's another method in which we use the discounted cash flows. It's very similar to, retirement obligations. You have a probability distribution assessing the cost that you may incur in any given year, and then you just simply discount it back to the current cash flow. A little more sophisticated because we're taking into account the time value of money, taking into account a probability distribution of occurrences. So again, the first thing you want to do is get a expected average from the probability distribution. So you just take 60% times 18,000, which equals 10,800. 30% of 20,000 is 6,000, and 10% of 27,000 is 2,700, which comes up to a expected cost of 19,500 when you consider all of those items together. Then you do it for the other two. 40% of 20,000 is 8,000. 60% of 30,000 is 18,000. So the expected cost out of those is 26,000, and then finally 30%, 25,000 is 7,500. 70% of 15,000 is 10,500. Then add these guys together. So you don't want to combine all of them because now you're going to weight them by time value of money, right? So how many periods is this going to be outstanding for? This one is this year, so that's 0. This one would be 1, and this one would be 2. Then you would have an I that you need to apply. I didn't give you one. I'll just give you 4% at this point to discount those cash flows back to the present. And when you use this as your future value, there's no payments. Then you get a present value for each. Well, the present value of this today is going to be 19,500, pretty easy. The present value of this is going to be 25,000. Actually, it comes out nice and even. And the present value of this today is 16,642. So you would have these amounts as your current liability, or I'm sorry, not your current liability, but your liability that you would express for warranties. Warranty expense would be the addition of all of these, which would be 19,500 plus 25,000 plus 16. Oops. Is 61,142. And then you would record the long-term, short-terms again, 19,500. Depending on when you were recording this, so we'll go ahead and record both of these as current. If we're at, say, December 31st, 2016, then that would be 44,500. And the final one would be the long-term, 16,642. Okay. Extended warranties are a lot different. Rather than treat them as an expense that accrues during the period, we treat them as a separate sale because of the nature of the warranty, typically longer term, not given by the manufacturer, backed by the business instead. Revenue is recognized when earned and realized, and in this case, we're going to have to wait to earn the total amount of revenue over the life of the extended warranty. It would initially be recognized as an unearned revenue account and then straight-lined into the revenue over time. So we have 650 warranties that cover 3 years and cost $199.99 each. So 650 times 199.99 is 129,993.50. So that's the total cost, what we would accrue would have our sales revenue. So say we got cash for it. And now we have some unearned or deferred revenue that will be recognized straight line over 3 years. So dividing that by 3 gives me 43,331 after rounding per year that I can recognize. So then at the end of the year, I would just reduce deferred revenue and record sales revenue at that time to show that, you know, a year has elapsed and we can now earn 1/3 of our initial outlay, or our initial receipt of cash. Promotions and cash rebates are another contingency where you put something out there, maybe, you know, promotional sale, and it's available to everyone. They're similar to warranties. You're going to use historical records to estimate the returns on the rebates and the promotions you're handing out. And with the new guidance on revenue recognition, more analysis is going to occur. If the option to exercise the promotional deal is an exclusive right to the purchaser, then it is accounted for under the Chapter 5 procedures, ASU 606. However, if it's a universal right, then it's not associated with the purchase of what we've done. Instead, then we're just going to treat it like a contingent liability, similar to warranties. So assume that we ran a circular on cereal products with rebates that allowed the customer to purchase their next box of cereal at half price. So we have records that indicate 60% of these rebates are going to be returned. We distributed 500,000 of them. Record the entries if each box of cereal is priced at $2.50. At the end of the period, it was determined that 350,000 coupons were used with the purchase. So we record the promotional liability when we actually run the circular that has the rebate attached to it. And you would estimate that at 500,000 times the 60% return rate means that they estimate 300,000 will be returned. And then each one is going to cost $1.25 because that's the price they get off of their box of cereal. So that comes out to $375,000 of estimated expense for running this promotion. Maybe a promotional expense and a promotional liability. For $375. Now, when 350,100 rebates are returned, now this was more than what we projected would be returned. We projected 300,000 would be returned. So we're going to have a little bit of an excess go on. We would reduce the entire promotional liability the 350,000 is going to trigger sales, right? So it's going to be sales in the amount of 350.1 thousand times 250. Now that is the sale price, right? Not the amount of cash we receive because we're taking rebates for these two. But the amount of total sales that happen are going to be 875,250. Divide that by 2. That's the amount of cash we record, 437,625. Right. Since we are recording cash of 437,625, we also do get to record the sales revenue for the full amount. That might seem counterintuitive somehow because we're taking coupons, but we already recognize the expense of those coupons before, so that we would net off some of the sales revenue against what we recognize as a loss already. So we do reduce it. We're not recording income for taking a rebate. But we also have additional expense to record. That's the amount of expense we underestimated because we only thought that 300,000 would be returned. We actually got an additional 50,100, and that results in an expense of 62,625. So if we had overestimated, we would be able to record a little bit of a gain, reversing some of the prior expense, right? Litigation claims are going to be common in the notes of the financial statements. They typically don't make it to the recognition level simply because no company will write down that it's more likely than not that it's going to be found guilty, right, or found culpable for the damages. So they usually report them as never more than reasonably possible. Also, they usually report the settlement as immaterial to the firm. Loss accruals due to settlements are rare, simply because of the the lack of desire to admit culpability in an ongoing lawsuit. It's not a very smart legal move. Your lawyer might fire you. Some lawsuits are adversely settled, are kept from accruing losses by the advancement of an appeal. So, for example, even if we thought it was probable we would lose, we can still appeal, which would hold the decision up in court longer, which would push out the likelihood of it happening as well as the time of it happening. Anything that happens after year end. So, for example, remember there's this waiting time from when we close the books on our fiscal year end and then we actually have a public report filed. So that's 2 to 3 months. It provides a window for some things to happen, maybe some clarity to contingencies that were recorded during the fiscal year. If the contingency meets the standard within this window, if it was a loss that should be accrued because it became more probable, as long as it began before the end of the year, before the fiscal end of the year, it would be reported in the public filing for that year. If the contingency is new, then it goes into what we call the subsequent events footnote. And that would be if the contingency could materially impact the financials of the company. And then finally, unasserted claims, so even claims that have yet to be brought to the company's attention, may be reported if it's possible that it could be broached by the parties that are considering it. It adds another layer. Is it probable that an assessment will be made, right? Is it probable they're going to bring these forward? If yes, is an unfavorable outcome probable? And is it estimable? And then yes. So we're just kind of adding this extra layer of probability that it will even surface. And then if it surfaces, we can judge it like every other contingency. Is it probable? Are the losses estimable? Then if those are yes, we accrue it. If no, then disclose it in the footnotes. And then again, gain contingencies are never put into recognition, only disclosed